138.79. You can just copy this trade, follow me, and then you can collect the profit. It's as easy as that. Okay, it's probably not as easy because it will take time. You need to know when you do this. So I place the order, 138.79 at British pound, and I'll speak to you later.
Reason to view it positively. If it's something related to runaway inflation concerns, then that would of course be a negative, but I don't think we're anywhere near that stage at this point.
Yeah, thinking about runaway inflation concerns, you don't see then the push up in commodity prices as worrying or flashing up red on your radar when it comes to inflation. We've been thinking about oil prices, about copper prices, about more broadly the metal space, and in food price inflation for some emerging markets as well. Shanti, are you concerned about that?
We expect there to be a moderate rise in inflation, and we think that's healthy. We don't want inflation at 0 or 0.5%, as we saw for some portions of last year. I think we will see inflation figures rise just from things like, for example, when VAT taxes are going up in Germany. So we'll probably see that feed through their numbers. The high oil prices will come through. But those increases will be moderate, and we believe central banks will look through any increases in inflation as temporary, and they'll keep interest rates anchored at low levels to support government borrowing, to support the recovery. We think that's going to be their main aim.
Shanti, stay with us. Shanti Kellerman, Brown Shipley Investment Director. Thanks very much for your thoughts so far. Coming up on the programme, we talk about the vaccine passport debate as they come closer to being a reality in parts of Europe. We get the details from Brussels next. This is Bloomberg.
Okay, guys, position opened at 138.79. Short position.
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for, and then chooses the direction.
we're still getting up to full speed. So although the sales environment has been strong, it'll just take another few months to get back to sort of normal levels of production across everything. I think day by day at the moment, we're building houses at a very normal rate because we've learned how to do it in a COVID environment. But, as I say, there's still a bit of a catch-up because most of the processes slowed down for several months last year.
Pete Redfern, the Taylor Wimpey CEO, speaking to me earlier this morning, talking about the extent of the recovery from disruptions of last year, where they are seeing that recovery, and the demand environment, which he seemed to look pretty favourably on. Taylor Wimpey's shares up by just over 3%. And interesting to see the market pulling back, though, from those levels we hit yesterday. Really strong gains for European and US markets yesterday. But we do pull back from those levels. You can see the energy and basic resources sectors are certainly the worst hit today. Now, let's focus back in on the UK ahead of the budget tomorrow. Shanti Kellerman, Brown Shipley Investment Director, is still with us. And Shanti, your thoughts on the UK asset space then right now as we head in towards the budget? Clearly, some of the home builders have been boosted by some of the policy direction that we hear about from the UK government this week. You've recently added UK small caps to some of your portfolios. What's your investment thesis?
So I think there's two different things to talk about. One is some of the stuff that Rishi Sunak might do this week. We think that it's possible a small rise in corporation tax could be likely because it's something where corporation taxes are lower than the rest of Europe. We think things like implementing a wealth tax would be very complex. And we also don't think the government will touch things like national insurance, income tax, or VAT, as those are in line with the Conservative government's pledges. On the other side of it, UK small caps, for us, we view that more as a play on the global economic recovery. Small caps have been an area that's outperformed recently. They lagged last year. And UK small caps are actually fairly global in nature relative to European or US small caps. We also thought the fact that the Brexit sort of risk premium will recede this year is another tailwind. And also we have some strength that's been coming through in the pound. So for us, UK small caps is more about a play on that recovery of the global economy and the UK economy as well.
And I suppose if you're looking for UK exposure, the small caps helps you get around the maybe over-reliance of larger indexes on certain asset classes, on certain sectors. And we see that today with the London market. Obviously, European equity markets in general are selling off, but the most under pressure sectors today are those connected with commodities, with basic resources, with energy names. Are you interested in those spaces at all, Shanti, then? If you're looking for small cap exposure, are you interested in those broader commodity plays around basic resources and oil?
We do have some select exposure to things that are in the mining sector and the energy sector. I think if you invest for UK clients and you're looking at that FTSE index, you need to have some exposure in that area. We think there is room for the oil price to rise further, simply because as demand comes back, that should cause some natural rises, although it's unlikely to be as steep as what we've seen over the past few months. Areas like copper and iron ore will be a bit more dependent on emerging markets and China's recovery because that's been driving a lot of the demand. That trend can continue, especially if demand picks up in China. And then the other issue you have in that space is it takes a lot more time to bring supply online for some of those things like iron ore and copper. So it takes a bit longer for those markets to rebalance than things like oil, where you can get, relatively things like shale and stuff can come back online much sooner.
And a lot of people talk about those businesses, those cyclical businesses, as being ones that might benefit if we pivot away from growth and more towards value, Shanti. And the reopening trade links in with that a little bit. How do you play the reopening trade at this point? How far through that do you think we are?
So I think largely what we've seen so far is the sentiment phase, where when we had the announcements about vaccines coming out last November, that shifted sentiment for a lot of those cyclical companies. We haven't actually gotten to the phase where we really have sustained economic improvement and the economies have broadly opened up. So that's what we need to see next. We're not going to see a full recovery in the value sector on sentiment alone. At the same time, I think the growth stocks can still do well even as the economy reopens. A lot of those companies have, very stable revenue streams, linked to structural long-term factors in the economy. So at the moment, our portfolio, we don't have a sort of tilt to one or the other. We're trying to keep our exposure balanced, and it's more about finding the companies and the opportunities within each of those sectors.
Shanti, thanks so much. Thanks for joining us this Tuesday morning. Shanti Kellerman, Brown Shipley Investment Director. And Shanti will actually be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Now, let's head across the channel now. EU health ministers were told on Monday that they need to ramp up coronavirus vaccinations. This as the bloc draws up plans for vaccine passports that could ease a return to normality for those who have been immunized. Meanwhile, German Chancellor Angela Merkel faces further pressure to ease the lockdown after her finance minister, Olaf Scholz, called for a quicker reopening. Joining us now with more, Maria Tadeo in Brussels. Maria, take us through some of the latest headlines that stood out for you then.
Well, Anna, the big conversation here continues to be the summer season, whether or not that can be salvaged and whether or not we'll need to show a certificate. And what is new here is that the Commission now says is working on the first step toward that. And it's something that they like to call a digital green pass that looks very much like a certificate to me, in which you'd be able to show whether you've been vaccinated and you'll also be able to show whether you've tested negative. And they say with this pass, this is really the first step towards mobility in the EU 27, whether you're looking at that for work, but also for tourism. And if everything goes according to plan, and that's a big question, it would be operational in 3 months, so meaning right before the summer. Now, what is interesting, Anna, here is that all of the discussions about vaccination and potentially the certificate towards the summer, it's very much about the EU 27. It's very much about countries that are member states of the European Union. There are virtually no mentions to countries outside of the EU, and that could get problematic because I also hear, and we've talked about this on the show many times too this week, that Southern European countries are now saying you have to look at the United Kingdom. The United Kingdom has got to be part of that list. If there is no consensus around it and tourists are not able to come into countries like Spain or Greece, then they would look into bilateral solutions. That means, one-on-one deal with the UK, which of course in the context of Brexit could be politically very delicate.
Okay, Maria, thanks very much. Maria today with the latest there from Brussels, a number of news lines to keep an eye on then in terms of the reopening story for various European countries and the role of passports and vaccination. Coming up on the programme, more from our exclusive conversation with JP Morgan's chairman and CEO, Jamie Dimon. He talks about the case for targeted US stimulus, the vaccine rollout, and whether his employees should get the vaccine. That is next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And So we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Welcome back to the European Market Open this Tuesday morning. European equity markets staging a very quick recovery, 18 minutes into the trading session, and we are now in positive territory on all of these major European equity markets. The media sector acting as a little bit of a counter to the weakness in the basic resources and energy space. Now, while JP Morgan's Jamie Dimon would like the bank's employees to get the COVID-19 vaccine, he said it's unlikely it will require the shots, at least for now. Bloomberg's Ed Hammond spoke with him exclusively.
Getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and getting the help, you overflood the system, you do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion that's unspent. That's before this $1.9 trillion. So there will be money, there's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and, people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JP Morgan to actually have people physically coming back to work?
It's very important. I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. But so I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. Most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So what before was like a deep dive question, now it looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And, I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And, so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible. So that question can't even be answered until June. But I do think you may see some companies do it. I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure. And I would say carrots and sticks, not mandatory.
Carrot and stick, not mandatory. The view there of JP Morgan Chairman and CEO Jamie Dimon speaking in an exclusive interview with Bloomberg's Ed Hammond. Catch more of that conversation throughout the day. We're bringing you plenty of it here on the European Market Open, and we'll be bringing you more of that conversation with Jamie Dimon as we go through programming here at Bloomberg TV. Let's get a Bloomberg Business Flash for you right now. Here's Laura Wright.
Thanks, Anna. China's top banking regulator is very worried about risks from global markets. He says bubbles in the US and Europe could burst because their rallies are heading in the opposite direction of their underlying economies. He's also concerned about China's property bubble, saying buying homes for speculation is very dangerous. Zoom thinks it can stay a part of daily life even after the pandemic ends. Investors fear the software maker cannot continue the growth it's seen during the pandemic, but the firm is predicting increases for 2022 as well. Zoom is trying to diversify and could add new cloud products to appeal to more business customers. Lex Greensil's plan to transform his trade finance business into a global giant is falling apart. Credit Suisse is freezing a $10 billion family of funds that invest in loans sourced by Greensill, citing uncertainty over the valuation of some of the debt. SoftBank is another backer signaling doubts about the loans. That's your Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London with your Business Flash. Let's take a look at some of the stocks that are on the move. Speaking of businesses that are newsworthy, Danny Berger is here with a look at some of them. And Danny, we've got a range of sectors for you here.
Really doing a range of earnings and various other news stories. Taylor Wimpey, a second day of gains. In fact, it's on track for its biggest two-day winning streak since November of last year. Yesterday, it was about that 95 mortgage plan coming from the UK. Today, it's all about their earnings, beating expectations, reinstating dividends, and the technical numbers looking strong too. Analysts pointing out that margins coming out of Taylor Wimpey also are impressive, beating expectations. So those shares up more than 3.3%. Let's look at some of the stocks on the downside though, and one of those to move lower is HelloFresh. That also reported earnings, and the earnings were extremely strong for 2020. We knew this was a trend, more people ordering online for their food. However, it's the view forward that perhaps is injecting this pessimism into the shares. They see the growth not happening as quickly, perhaps because we're getting some normalization in the world, and margins also worsening, seeing EBITDA margin around 9 to 12% for the fiscal year of 2021. Now, the other company in the headlines for the wrong reasons is Boohoo. Shares sliding in today's trading. Sky News is out with a report that the U.S. might ban imports from Boohoo over concerns of use of slave labor. Sky saying that the U.S. Borders control there think they have enough evidence to seek charges against Boohoo. I want to take a quick look at what the macro market looks like. It's definitely a day of taking a breath after what yesterday felt like a risk-on sprint. You can see behind me, Stock 600 not really moved. Neither are 10-year yields. Those are pretty at a standstill, but oil falling ahead of the OPEC Plus meeting this week. Anna?
Okay, thanks very much. Should say, Danny, thank you for that. Should say that Boohoo saying to Sky that if they discover any suggestion of modern-day slavery, they would immediately disclose this. So we'll see where that conversation leads. Coming up on the program, Man Group defies the hedge fund investor exodus with a year of overall inflows. We're going to be speaking exclusively with the CEO, Luke Ellis, about the outlook for the world's largest listed hedge fund. That conversation coming up next. This is Bloomberg.
This capture can be integrated into games, teleconferencing applications, education platforms that are built with the standard 3D content creation software.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European market open. 30 minutes into your European trading session. And European equity markets have been either side of the flat line so far this morning. They seem to have settled just below the flat line once again, so making some modest losses, down by around 0.1%. US futures have been pointing to the downside and continues to do so as we go through the early part of the European trading session. The yield on the US 10-year just ticking up that little bit, 1.42%, but not making the moves that we saw in last week's trading environment. That is for sure. Now, Man Group, the world's largest publicly listed hedge fund, defied a wider exodus of capital from the industry by raking in $1.3 billion of client cash in the fourth quarter. That influx helped lift assets to a record high, and the company's CEO says he's confident in the growth trajectory and has entered the year with good momentum. Luke Ellis is the Man Group CEO, and he joins us now for an exclusive conversation. Luke, very good to speak to you. So looking at these numbers then for the fourth quarter, raking in $1.3 billion in client cash in the fourth quarter. What do you put that down to?
Well, in the end, these things are put down to having very good relationships with your clients and about delivering high quality products. You know, I'm super proud of how the Man team dealt with 2020. The year threw sort of pretty much everything at us that it could do, and we came through in a sort of very resilient way, business as usual. So we've got farmers, as you said, at the highest level it's been. We've got records across most of the things. We had net inflows. We beat estimates. We're pretty happy with the momentum we have within the business.
You clearly you have many parts to the Man Group business, a diversified business. Quants and computer-driven hedge funds are part of that conversation. I wonder if you can tell us how that side of the business has been faring as we've gone from 2020 into 2021. Last year was a difficult year for many in the quant space.
Sure. Look, I think what's really important is the diversification we built into the business over the last 5 years, so that, you know, in the nature of markets, and particularly when they're as volatile as they were last year and seem to look like they're going to continue to be in 2021, you know, that suits some of the strategies, doesn't suit some of the other strategies. We are very technology focused across the firm, either in the quant side or using it to help the discretionary side of the business, letting the humans focus on the bits where they have an edge rather than collecting data. Our quant side, basically the directional side of the quant stuff, so the stuff that came out of originally as CTA, had a very good time last year. Basically did a good job of managing in the crisis, and then did a good job of capturing the returns that were available in the fourth quarter. And that business continues to be in very robust shape. The hard thing for quants last year was around equity factor investing. That was much harder last year, but it feels like the pressure's come off that coming into 2021, and it's starting to be a more normal environment for factors.
Yeah, I mean, Luke, what has the business learned about operating those kinds of funds during a pandemic? I mean, it must be so incredibly difficult to model something like a pandemic. So far, been once in a century event. How has the business learned, do you think, about how to deal with that kind of phenomenon?
Well, I think the interesting thing is the market effects when they happen during the course of that, you know, actually the models coped really rather well with. And, you know, while we all feel that it, and, you know, from a personal point of view, it's been a once in a, whatever it is, 100-year experience. From a market's point of view, it happened quickly, but it was relatively normal. So the models did a great job of getting out of the way of trouble as the pandemic hit, and then got into risk as the year progressed. I think the really interesting thing for quants is now where, obviously a lot of models look at one-year data. And right now, one-year data is extremely volatile based not on what's happening today, but basically based on what happened a year ago, and whether that's in the data or out of the data. So, we're doing a lot of work to make sure that the models understand what is likely to repeat and what isn't likely to repeat, and don't get caught up by events from a year ago.
Yeah, really fascinating, those comparisons year on year for many lines of work, and yours not least. Let me ask you about the discretionary trading unit then. Are clients returning to the sort of more expensive funds, the higher alpha funds, or is it more about the more commoditized products? What are you seeing appetite for?
Well, so we don't do the passive stuff and the quasi-passive. I think passive is a very good investment for many clients, and if you can get your investment returns out of pure passive on a forward-looking basis, that's a good thing to invest in. We're in the high alpha business, and while the fees might be higher, we think the value is very good in things where you have high alpha. It's a sort of index plus a smidge stuff, which is bad value. What we've seen is, there is definitely demand for high quality, long only, high alpha product. And then importantly, what's coming through with all the concerns in the bond market is basically the demand for the sort of lower risk bond return, bond risk type of liquid hedge fund is, looking a very good alternative for clients compared to, most people are sitting looking at their bond portfolio, scratching their head.
Yeah, I wonder how that rising yield environment looks to you, and you've given us a bit of insight there, Luke. We spent the last couple of weeks talking about yields on US Treasuries going higher, and I wonder what that is doing to the conversation with clients and what they're looking for.
Well, I think, from a client point of view, you could see that they're all staring at their bond portfolio and worrying. The big thing is people, in the end, why would you own treasuries at one and a bit? Why would you own European government bonds at essentially zero yields? Well, the main reason you're owning it is as a store of value and a diversifier to your equity portfolio. The interesting thing we've seen in the last 4 to 6 weeks is the correlation between bonds and equities is definitely changing. Interestingly, it's very easy to forget. The last 20 years, we've seen bonds and equities be negatively correlated, but essentially for the previous 200 years, bonds and equities were positively correlated. And clients are now looking at their government bond portfolio, worrying whether it's going to give them the diversification, and are looking for other alternatives that might give them the diversification they're looking from something or the stable yield without having the correlated drawdown.
One of the other things we've talked about a lot on Bloomberg TV recently, Luke, has been the rise of retail investors, the GameStop, the Reddit phenomenon. Clearly, I'm sure something that you've heard a lot about. In terms of how this rubs up against your world, clearly the Reddit crowd have had a lot to say about hedge funds in recent months. I wonder if this has led to any kind of reevaluation from your perspective about short positions and about the risks associated with short positions.
So, we believe that shorting has a valuable function for the market, and, we only in Europe have to look at Wirecard, and without the shorts, that fraud would have gone on for a lot longer. I think shorting provides a useful function for the market of getting securities to their natural level quicker, and that makes markets more efficient. I think being short something where there is very high open interest, short interest, is it's at best an extremely high-risk strategy. We tend to be very careful about not wanting things which have high short interest, because you're always subject to a squeeze if that happens. It's unusual that the squeeze comes from retail, and assuming it did come from retail, but you're always subject to a squeeze. So we tend to be looking at ideas where other people aren't trafficking in the same idea. And so therefore the short interest tends to be significantly lower. And then, shorting requires very good risk management skills, and you have to be able to change your mind quickly, because otherwise you can get stuck in a position and be squeezed in the way we've seen. We're very proud of the way that we manage risk here. We have an excellent trading desk that we've really concentrated on using technology to make sure we can get out of positions very, very efficiently without the market seeing our footprint. And then shorting is a very valuable function to bring both to the market and to client portfolios, because you can give them a more pure alpha source.
Luke, really good to speak to you. Thanks for spending time with us here on Bloomberg TV. Luke Ellis, the Man Group CEO. Coming up on the programme, our weekly segment where we take a look at the world of private capital. Danny Berger is going to be here speaking with Nikos Stathopoulos from BC Partners in this week's Money Undercover. That is next. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
The President and I are pushing the United States Congress to finish passing our American Rescue Plan, so cities have the resources they need to innovate and replicate the best ideas. This plan includes critical support for those communities that have been hardest hit, keeping small businesses open and first responders on the job.
Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? You know, and we just throwing money at people at one point. So, and there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it.
That was Vice President Harris and JP Morgan CEO Dimon speaking about stimulus with us on Bloomberg a little bit earlier on this week. Now, global buyout activity is on a tear this year. Through February, deal value is 60% higher than the average start over the past 5 years. So that's pretty strong. That is according to new research out from Bain & Co. this week. With this week's Money Undercover conversation, let's get now to Danny Berger, who has a guest. Danny.
And thanks so much. Joining me now is Nikos Stathopoulos, partner and executive committee member at BC Partners. Nikos, first off, thanks so much for joining. And in that deal activity volume that Anna was talking about, it does feel like there are a lot of family-owned names that have been coming up. So you think of someone like Panini or even Birkenstock that over the past week have been looking towards buyers. Why would we see this environment now where family-owned businesses want buyers?
Well, good morning, Danny, and nice to be here with you again. I don't think it's such a new phenomenon, really. I think we see it a bit exacerbating now post-crisis, and maybe it's a bit heightened at the moment. But we at BC have been seeing this for the past at least 2 decades. I can give you a statistic that in the last 10 years, for example, about 50% of the deals we did have been with families or founders. And just in the last 3 years, about 80% of the deals have been from founders and families. And I think this is driven by a few things. One is, in most cases, there is a succession issue for some of those. So they feel that actually selling their business can solve this, partly at least, if not totally. Secondly, we've seen in some markets, like in Southern European markets, private equity is becoming a bit more mainstream, it's becoming more knowledgeable, and therefore founders and families are more comfortable selling to a private equity fund. And I would say thirdly, the IPO markets have been a bit more choppy, so we've been a nice source of alternative solution for these families.
So if that's the environment that makes families want to look at this option more and look at private equity more, how do you at BC take advantage of that? Do you push that 80% of businesses being family owned even higher from here?
We will try. It's not always easy because, of course, it's a question of supply and demand. So there's certainly the demand is there in our industry with more than $2 trillion still to invest, but we need the supply and we need these families to be willing and able to sell their assets. What we try to do is we try to use our network to meet all these families, to tell them why we think private equity ownership of their company will be valuable and will be the nice next step, and frankly why we can be good stewards of their business for the next few years.
Of course, it's not just family-owned businesses that are looking at partners. Private equity in sports has also been pretty big over the past year. Bloomberg, we've reported that Bundesliga, the German football league, is looking for minority stakes in their broadcasting rights, and that BC has been one of the firms to look at this. So is that something you're still interested in, and why?
We are still interested, as we've been interested in sports for a while now. I mean, the way we are approaching sports investing is more from a content perspective. I find sports as being an extremely valuable source of content. It's real time, it's unique in most cases, and that content has value. So ultimately, I think our industry has realized that, like in the case of music, like in the case of movies, also from that perspective, sports has very attractive content that can be monetized, whether it's through a club or through a league. I think it's less relevant, and it depends ultimately what will be available. And I think that monetization of the content will be a trend that we will probably start seeing more. Sports is an industry which is not very institutionalized, and I do think that the private equity industry can be a bit of a catalyst in institutionalizing what is a very attractive industry, frankly, and certainly growing.
You mentioned the difference between the league and the club. I know Inter Milan's another one that's been in the headlines. Is that an opportunity that you're actively bidding for at the moment as well?
I cannot comment on deals that have not actually happened, as you can imagine. But certainly we have been exploring also investing in the sports industries, as I mentioned, both through the league and through the club ownership. And ultimately, club ownership has to be with a club, in my mind, that has also very high probabilities of competing at the highest level of competitions.
How does the growth of Netflix, Amazon, of course, they look at live programming too. How does that change the value of these different potential sports content deals?
I think it's great examples of exactly the type of assets that are growing. And it's a good example, of course, that you need to invest in that content if you're willing to monetize it and to try to maximize value. But I think the likes of Netflix, etc., have shown that institutionalizing a certain sector and the content can become very, very valuable. If you look at the value of Netflix today, of course, there's no comparison to the value of any sports club, regardless of what type of sport, whether it's football or basketball or any of the biggest sports in the world.
There, of course, does tend to be concern when you get private equity deals in sports leagues that perhaps, the majority of it goes away, it gets away from being sort of a local club. Quickly here, Nikos, how do you sort of alleviate those concerns when it comes to sports deals?
I'm not sure that's that big difference, frankly, of being owned by private equity or partially owned by private equity, because most transactions to date, at least, on a league level, have been for a minority stake. So private equity will be coming as a funder of capital, potentially bringing some more professionalization, some more discipline, some more institutionalization in leagues and in clubs that tend to be mostly individually owned today. So I don't think there should be any concerns on an industry that has proven to be bringing discipline to any sector that it has been investing in the past, really.
Right. Well, discipline definitely fits with the whole sports theme in general. Nikos Stathopoulos, BC Partners Executive Committee member and partner, thank you so much for joining us. Anna?
Danny, thanks very much. Thanks for bringing us that interview. Coming up on the programme here on the European Market Open, concerns over shortages in goods from copper to sugar have helped send the Bloomberg Commodity Index surging. So we're asking this question: how sustainable is the commodities rally? We'll put that to Laura Cooper, Bloomberg Markets Live macro strategist, who joins us next. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
During this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open, 53 minutes into what is now a positive European trading session. We have been either side of this flat line this morning, but for now we settle at around 0.1% to the upside. The Stoxx 600 at least. A little bit of underperformance coming through at the periphery, but essentially most of these European equity markets flat to positive. Most Asian stocks slipped today after China's top banking regulator said he's very worried about risks emerging from bubbles in global financial markets and the nation's property sector. Joining us now, Laura Cooper, Bloomberg Markets Live macro strategist. Laura, what kind of message do you think the Chinese are trying to send when it comes to this conversation around bubbles that did seem to take the edge off the Asian session?
Well, I think there's kind of two components to this. So one, the fact that worried about kind of risk in China's property sector does potentially tilt towards kind of this renewed focus on deleveraging at the National Congress this coming weekend. But I think more globally, the reason why we saw this sapped sentiment on these comments is because he is warning that what the euphoria that we're potentially seeing in U.S. and European markets is at odds with the directions of their underlying economies. But I think, we're seeing a fairly muted, obviously short-lived response to this because we have seen these bubble narratives brew up before, and policymakers on this kind of area of the world are largely dismissive of this. Yes, they see pockets of froth, pockets of exuberance, but ultimately they don't see bubbles. And so last week, after this kind of bond rout has really shaken some of that froth of equity markets, what we're seeing is investors refocus back on that reopening trade. So that's why we saw that strong bounce yesterday, and that does look to have legs in the week ahead.
Just a quick word on some data breaking across the Bloomberg terminal, Laura. German unemployment rose by 9,000 in February. The estimate was for a 10,000 drop, so that does not seem to be moving in the right direction. Just thinking about where we've headed in our conversation and thinking about bubbles, and I know the question of the day that we're asking is around commodities and where we head more broadly on the commodity story. Where do you see commodities? How is the conversation evolving around commodities, and how sustainable is the rally? We see some steam coming out of it in today's session.
Well, certainly, commodities are under slight pressure today, but I think really just the fact that it has been quite broad-based does suggest that there is room to run. We have this perfect storm of tight supply constraints. We have supply chain disruptions really boosting agricultural prices. And then we have just this broader inflation hedge against the stimulus backdrop that is supporting the commodity space. Now, in terms of longer-term sustainability, I do question whether this momentum can be sustained. And I think that's largely reflective of the Chinese story. So in the past super cycles, we had China as a strong demand impetus, whereas this time we are seeing that Chinese credit cycle start to turn. Okay. So it could be the case where China actually drags on demand.
Okay, thanks so much, Laura. Laura Cooper, Bloomberg Markets Live macro strategist. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets fairly flat now this hour as we get that underwhelming data on German labour markets this morning. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
There are a lot of people suffering who need help. Get us through the problem, get the country going, but try not to overdo it.
K-shaped recovery is not acceptable. That's the bottom line.
Survival is not the end game. We want our cities and our countries to thrive, not just survive.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance, the early edition on Tuesday, the 2nd of March. I'm Francine Lacqua here in London, and here's what's coming up on today's program. China's top banking regulator says he's very worried about frothy foreign markets while stocks and futures slip. We'll discuss that with our chief Asia economics correspondent. Not buying treasuries, Jamie Dimon tells Bloomberg exclusively that U.S. debt is not attractive to him at these levels. The J.P. Morgan chief executive is keen to get staff back to the office. More of our interview throughout the program. And making London competitive, the UK Chancellor Rishi Sunak wants listing rules in London to match New York and the continent to attract more IPOs and SPACs to the city. The LSE director Minouche Shafiq joins us shortly. Now let's get straight to our top story. And the stock rally has ebbed this morning after yesterday's 2.4% surge in the S&P 500. Well, Jamie Dimon has told Bloomberg that he would not buy treasuries at their current level, but the Fed is continuing to play down the rise in bond yields.
I think we obviously have control of the yield curve at the short end. And at the longer end, I think when it moves, it depends a lot on the driver. If the driver is normalizing inflation expectations, that's welcome. If the driver is, as it seems to be, news about vaccines or news about health of the economy or news about fiscal stimulus, then I think it's a natural reaction.
Well, let's now get the view on the markets with our Danny Berger. Danny, there's quite a lot of news to digest. First, the Jamie Dimon interview, but also really the Chinese banking regulator going pretty strong this morning.
Yeah, and I think that has started to fuel these concerns of what's happening in the market. And if we can go ahead and look at what the markets are doing, there is some declines. It feels like yesterday's risk-on sprint that we saw in equity markets is at least just taking a breath. So Europe Stock 600, it's been back and forth all morning. Gains, losses now basically unchanged. But those concerns of are things running too hot? Are valuations too high? Definitely showing themselves through the S&P 500, despite the fact that bond yields are more or less unchanged this morning. So the story isn't necessarily right now, at least, that sell-off in bonds hitting equity markets. Finally, though, we're also seeing crude tumble lower more than 1%. That's ahead of the OPEC Plus meeting. So when you look at some of the negativity in Europe, it's really the energy space that's getting dragged down. I want to show you, though, while we're talking about is there too much optimism? Is there too much euphoria in markets? Quickly, I want to show you this Bank of America chart because this is their sell side indicator. So this white line, the higher it is, the more optimistic the sell side is, the lower it is, the more pessimistic. The idea behind this is it's a contrarian indicator. Once it touches this line, which is one standard deviation of the average, it's a sell signal. People are too optimistic. Bank of America now says we are 1 percentage point away from that threshold. And Francine, this is a really good indicator, at least it has been in the past. Last time we crossed this threshold was June 2007. It did not go so well after 2007 when equities fell about 13% over the next year. So if you want another reason to be fearful of the market, Bank of America has you covered here.
Danny, thank you so much. I'm sure they do have us covered in terms of concerns out there to watch. Now, sentiment took a further hit after the chairman of China's Banking and Insurance Regulatory Commission said he's very worried about bubbles in both markets, overseas and at home.
The key problem of this sector is the bubbles of this sector, which, as I said, the biggest gray rhino. A lot of people want to speculate or make investment through buying homes, which is very dangerous.
Well, joining us now to discuss all of this is Enda Kern, our Chief Asia Economics Correspondent in Hong Kong. Thank you so much, Enda, as always, for joining us.
Okay, ladies and gentlemen, if you follow this trade, if you sold short with me just at the beginning, we're going to place stop on profit. Price I'm looking to stop at 138.77. Let's wait until the price will go lower. It's all about how much broker gives you, permit you to place stop on profit. In our case, we need to, the price is supposed to go below 2-3 pips. So I'll be able to put stop on profit at the price, in this case, 138.77. So I'm waiting until the price will go up to 138.75. So then, only then broker will let me place this price. Otherwise, I will have to put my price at the higher level, maybe on even like 138.79 or 138.80. You know what I mean, yeah? So let's see. Now it's look like it starts moving up. So we'll see. We'll see if it will go up. I'll wait. I will place stop on profit a bit later on. Let's see. Let's wait. I'm still waiting for. No, let's wait for another time. Hey guys.
Domestically, we know that China's recovery has been pretty strong, and we know that the central bank is trying to talk about tapering support for the economy, not necessarily tightening per se, but at the same time, this raises questions about will they take further measures in the property market.
Okay, I'm placing a stop on profit, like I said, at 138.77. Right now, I'm able to do that. So whatever happened, I will be in profit. If the direction, momentum of the chart pattern, whatever happened with this pair will change, and if it will go up, I will be in profit. Okay? Nice trade, guys.
Of the British Fashion Council, Stéphanie Fair. Up next, though, we speak to one of the world's most influential economists, the director of the London School of Economics and former deputy governor of the Bank of England, Manoush Shafiq. Now, please send us all of your questions for Manoush and Stephanie using the IB. You can just go IB plus TV. We'll talk to Manoush next about her new book. This is Bloomberg.
going to move further my stop on profit to 138.74. Okay. So anybody who wants to get strategy we use, you can get it from our company website, company.co.uk. You can get it from, we're going to have tomorrow webinar. If you can see, we on Ticker, we publish the website where you can register for our webinar. We give strategy, and you can discover how we trade, how we use the strategy. So you're welcome to register.
There's a very good chance you're going to have a gangbuster economy for the rest of this year and, you know, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. You know, I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But you know, I would suspect there's a pretty good chance you're going to see rates going up, and you know, people starting to worry about that at one point. I've been very clear. I would not buy 10-year treasuries, just so you know.
Well, that was, of course, the JP Morgan Chairman and Chief Executive Jamie Dimon speaking in exclusive conversation with Bloomberg's Ed Hammond. Now, you can catch more of that conversation throughout the day. Now, Minouche Shafik is one of the world's leading economists. During her career, she has worked in senior positions at the World Bank, the Department for International Development, and the IMF before becoming Deputy Governor of the Bank of England in 2014. She now serves as the director at the London School of Economics, and her new book, What We Owe Each Other, is a new social, What We Owe Each Other, a New Social Contract, actually comes out this week. In the book, Minouche sets out the basis for a new social contract fit for the 21st century. Now, she draws on evidence from across the globe to identify the key principles every society must adopt if it's to meet the challenge of the coming century. Well, Minouche joins us now. First of all, Minouche, congratulations on a wonderful book. It's 225 pages long, so it's not a heavy lift, and it's just way smart. When you look at the social contract, Minouche Shafik, and the reason why you actually decided to write this book, has it gotten worse because of the pandemic? I know in the book you also specifically talk about the social contract that businesses need to focus on.
Absolutely. I think well, it's great to be with you, Francine, for starters. The book, I started writing the book after 2016, and when the world seemed so incredibly divided, and we had Trump and Brexit and rising populism around the world, culture wars, and that was the original motivation. But of course, the pandemic has revealed the fault lines in our society even more apparently. And it's clear who suffered the most from the pandemic. It's the poor, minorities, women, and people in precarious work. And I think in many ways, the idea of a new social contract has become even more relevant after the pandemic.
Have we always been a me society, but because capitalism has grown, it's much more evident, or has something actually changed in the way we do business and we look at the people around us?
Well, I think the focus on me got more intense in the 80s and 90s. If you think about the social contract with business since the 1980s, government policy has been focused on maximizing efficiency, liberalizing trade, privatization, deregulating labor markets. And firms have responded by cutting costs, reducing benefits, and outsourcing their supply chains. And that has benefited shareholders and customers because we all buy many products now more cheaply because of those efficiency gains. But it has come at significant costs for workers whose incomes have stagnated and they face much greater insecurity in their lives. And I think the combination of the reaction to the financial crisis and COVID mean we have a chance to rethink that social contract with business.
How do you think that social contract should change, and how much of it do you think will change?
Well, so I think in terms of how it should change, I think it means more pressure on companies to pay their fair share of corporate taxes. And I think it means providing all workers with benefits regardless of the kind of contract they have, if they are flexible workers, gig workers, and so on. On corporate taxes, you can see the debate happening in many countries already, that corporate taxes have fallen dramatically over the last 30 years, and I think many countries are now looking to change that. I think it's compounded by the fact that international tax avoidance has gotten so prevalent. Something like 40% of corporate profits around the world are in tax havens. Half of the companies in the UK, for example, half of the subsidiaries of multinationals pay no tax in the UK. I think there's an opening because there's a very clear proposal from the OECD that proposes two pillars. One, that you set a minimum corporate tax rate globally, and so that countries won't compete with each other to try and kind of beggar their neighbor. And second, that you start taxing corporations on where the economic activity occurs rather than where the legal entity is. And the fact that Janet Yellen last week reversed the Trump administration's opposition to this policy means I think we have a real chance of a breakthrough on a more fair international corporate tax system.
Minusha, at some point in the book, I think about 3/4 in, you lay out 4 very important questions, which is actually, how can we retain the benefits of flexibility while reducing risk and insecurity for workers? You also ask, how can we create more high quality jobs, and how do we enable workers to adjust as jobs change? How do we provide income security as well? Out of those 4 questions, I guess the most difficult one is, how do you provide high quality jobs, and whose job is it to retrain workers? Is it businesses or governments?
Yeah. So I think one of the phenomena of the modern labor market is that workers are less attached to their employers. People turn over jobs more quickly, and that provides less of an incentive for firms to train their workers. I think we can do 2 things about that. One is that just like we give firms tax credits to do research and development, we could give them tax credits to train their workers, so they will train them more than they might otherwise do. I think the second thing is that most countries in the world underinvest terribly in retraining adults. And we know it can work. There's huge evidence from hundreds of studies that over time, reskilling adult workers can work, but you have to provide sufficient resources and you have to take a long-term view. Now, that probably has to be financed through public sector funding. But I think if you do that, you can create a labor market where firms don't have to worry about letting workers go. If you look at, say, the Nordic countries, Denmark, Sweden, and so on, Finland, they have very high worker turnover. People get fired all the time, but it's not a problem because they get generous unemployment insurance, very quickly get put into training programs, and very quickly find new jobs. And that kind of labor market, where you retain the benefits of flexibility, but provide workers with security, I think is one that would work, but would require more public funding for reskilling.
Minusha, thank you so much. Minusha Shafiq there of the London School of Economics stays with us, and we'll talk a little bit more about productivity next as well. Up next, we continue our conversation with one of the world's leading economists, the London School of Economics director and former deputy governor at the Bank of England. Minusha Shafiq is back. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's too early, I think, to judge by how much taxes will need to go up or spending cut. I think it is, we keep alternating between moments of pessimism and optimism. The right thing to do now is to keep options open and not to commit ourselves to a precise path for government tax and spending measures.
Well, that was the former Bank of England Governor Mervyn King looking ahead to tomorrow's UK's budget on this programme. Now, Rishi Sunak's budget statement in the Commons will be closely watched, not least by the City. The UK Chancellor will reportedly use a budget to launch a post-Brexit fight back to help London compete with New York, Amsterdam and Frankfurt. The Financial Times says that the UK government wants to bring in a new stock market listing regime with a review on dual-class shares, IPOs and SPACs. Well, we're back with Manoush Shafiq, one of the world's most influential economists. Between 2014 and 2017, she was the Deputy Governor of the Bank of England, and since 2017, she's been the Director of the London School of Economics. She also has a book out this week called What We Owe Each Other. And Manoush Shafiq, thank you so much for staying with us. When you look at what you write in the book, the new social contract, and I guess, the ability for the UK to really forge its path now, I guess in part thanks to the pandemic, which means that they can spend more, that they can kind of change, but also in part because of Brexit. How do you see the UK economy behaving in 3-4 years? What needs to change now for it to flourish later?
Well, I think a key thing is around trying to tackle the productivity puzzle that we have all been talking about for so long. I think one of the things I say in the book is that part of the problem is that we don't take advantage of all of the talent in our societies. When you look at the US, for example, you can explain a huge part of the productivity in the US economy over 50 years, because jobs which were the purview only of white men for decades were suddenly opened up to women and people from ethnic minorities. And that can explain 20 to 40% of the productivity gains in the US. And so policies of tapping into the talent, making it easier for women to stay in the workplace, opening up jobs to a wider and more diverse group of people is actually a key part of the productivity challenge. I think another part is around competition. And There's been a lot of debate about competition policy. I think you can see in many, many sectors of the economy, we've actually seen growing concentration. And so I do think it's time for us to rethink competition policy for the digital age.
Yeah. And Minouche, you touch about this in the book, is basically the only question worth asking, even if you're a politician, even if you're, almost a central banker, is will young people have a better or worse life than their parents? Is that how we should measure success actually in our economies?
Well, that is the central question for the intergenerational social contract. And for the first time in every advanced economy, polling shows that people think their children will have a less good life than their parents. And that's an extraordinary phenomenon. And I think we have to ask ourselves why that is. And there are many reasons. One is that young people today have to often pay for their education, they have higher debts, their job prospects are poor, and house prices are more, have gone up. And so all the things that previous generations benefited from in terms of higher levels of social spending, lower house prices, buoyant job markets are not there. And the pandemic has only made that worse. And so I think we need to think very hard about this coming generation. There's several things we can do. I've long advocated that we should give young people an endowment to fund their education throughout their adult lives, and that would enable them to reskill and retool for careers that are going to last 40 or 50 years. I think we also have to think what old people should be doing differently. People are going to have to work longer and delay retirement. People now expect to spend about a third of their life in retirement. That's a very recent phenomenon. People used to spend very few years in retirement and were able to contribute through taxation far longer. And I think older people need to think about delaying retirement so that they don't draw on pension schemes too early. So I think our intergenerational social contract is in trouble, but there are things we can do to make it more fair.
Minouche Shafik, thank you so much, and congratulations again on the book. The London School of Economics director, former Bank of England deputy governor, and her new book out, What We Owe Each Other, is out this week. Now, on to banking, carrots and sticks. Jamie Dimon refuses to make vaccines compulsory for JP Morgan employees. Up next, we bring you more of our exclusive interview. We also look at everything that's going on in the markets. Dollars actually gaining a touch. S&P 500 futures pulling back after the index capped the best day since June. European stocks ticking up, commodities sliding a touch. This is Bloomberg.
certainly the technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Not buying treasuries, Jamie Dimon tells Bloomberg exclusively that the U.S. debt is not attractive to him at these levels. Up next, we bring you our exclusive conversation. China's top banking regulator says he's very worried about frothy foreign markets, stocks and futures slip, and making London competitive. The UK Chancellor Rishi Sunak wants listing rules in London to match New York and the continent to attract more IPOs and SPACs to the city. Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. I'm Francine Lacquet here in London. Now, carrots and sticks. JP Morgan's Jamie Dimon would like his employees to get the COVID-19 vaccine, but he says it's unlikely that the bank will mandate the shots, at least for now. Bloomberg's Ed Hammond spoke with him exclusively.
Getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and getting the help, you overflood the system. Yeah. You do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion, $1 trillion that's unspent. That's before this $1.9 trillion. So there will be money. There's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and, people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JP Morgan to actually have people physically coming back to work?
It's very important. I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. But so I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. Most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So but before it was like a deep dive question. Now it looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And, I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And, so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible, so that question can't even be answered until June. But I do think you may see some companies do it. I mean, I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure, and I would say carrots and sticks, not mandatory.
Well, that was, of course, the J.P. Morgan chairman and chief executive Jamie Dimon speaking in an exclusive conversation with Bloomberg's Ed Hammond. Now, you can catch more of that interview throughout the day. Now, as we just heard, Jamie Dimon has been one of the most vocal supporters for a broader return to the office. He said his firm has seen alienation amongst younger workers and that an extended stretch of working from home could bring long-term economic and social damage. Well, joining us for more on this is Bloomberg's finance editor, Marion Dakers. Marion, great to have you on the program today. What's the general feeling amongst top banking executives about when their staff need to return to work?
Well, I think in London, currently it's obviously driven by the levels of virus. We're still in a national lockdown, so nobody's going anywhere in the short term. In the long term, for example, Lloyd's have done a survey of their staff, and something like 3 in 4 want to work from home, most of the time. So as lovely as Jamie Dimon's idea of breakfast, lunch and dinner meeting people sounds for the very senior level, I think most people are expecting some sort of hybrid solution rather than everybody piling back into the office as soon as they can.
Marion, when you look at the Goldman Sachs chief executive, though, he basically said it's just not working having people work from home. It's unnatural. Will we see the big Wall Street banks demanding employees go back to work, and companies that maybe are seen as less aggressive, maybe some of the European banks, even the UK banks, work differently?
I mean, he's right that it's been an aberration, but the whole previous year has been extremely unusual. People have become teachers and community support workers as well as investment bankers, and some of that will fall away in the coming months, and then we'll get a clearer picture of exactly what people can do from home in a more normal setting. I mean, I think HSBC, who have a big investment banking presence, they are also looking at some sort of hybrid model, so acknowledging that some of the work can be done from dining room tables, as I'm doing now, rather than requiring even the investment banking staff to get back into the office and travel.
Marion, what about this morning's report that Rishi Sunak wants to make the city more competitive around listings?
Yes, I think that'll be welcome news for people in the City of London, having been largely left out of the Brexit trade deal and economic discussions over the past couple of months. If he can reveal something in the budget that will remove some of these hurdles that might keep firms from listing in London, particularly these tech firms that are held up as a growth industry for post-Brexit Britain, will be extremely interesting in the budget tomorrow.
Yeah, it should. Thanks so much, Marion Daker, there, finance editor for Bloomberg. Now, parading down the virtual catwalk, up next, we speak to the chair of the British Fashion Council on the impact COVID and Brexit have had on the industry. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get a view on the markets with our Danny Berger, who's been looking at the morning's biggest stock moves. And Danny, it's all about China, and of course, Treasury's always simmering in the background.
Yeah, it absolutely is. And I think that's part of the reason we're getting so much divergence in today's market, because it's one that is shaky, it's vulnerable, and should there be another, should we say, spike in Treasury yields or anything like that, it's one that could really set the market off. But that's also giving today some breathing room for the individual stock stories to actually have a difference on the price of equities, rather than everything dominated by the macro. Taylor Wimpey, for example, reporting earnings today that beat expectations, its outlook beat expectations in terms of its margin, and also reinstating its dividend. It's this UK housing story that's been really strong, with the government set to continue to support mortgages. Now, some of the biggest movers to the downside: Boohoo Group might face a U.S. import ban over concerns of practicing modern-day slave labor. The U.S. says, and this is according to Sky News, and the U.S. authorities say that they have enough evidence to move forward with this. Boohoo telling Sky that if they had known about anything, if they'd seen anything like this, they certainly would have let authorities know. Finally, HelloFresh also moving to the downside, reporting very strong earnings, but it's the outlook that is concerning as well. And Francine, I also just want to say quickly, pre-market, Zoom moving much higher, earnings very strong for them. They had moved up 10% in aftermarkets trading, pre-market 8% as well. They're forecasting an earnings growth of about 43%, beating the average analyst estimate of 37%. Francine, even as the world normalizes, I guess we're still all going to be on Zoom.
I know, Zoom. I mean, I can't tell if it's my best friend or my nemesis. This is like, the only question worth asking in 2021. Danny Berger, thank you so much with all of the main movers. Now let's get straight to the Bloomberg Business Flash.
Okay, guys, good trade. As you can see, we sold at 138.74 British pound. Let me, I'll show you where. Just right here. Position closed. It took us what? Hour and a half to complete this trade. Well done, all of you who follow this trade. You made already a good profit. If you use our strategy, you know what we did. If you don't, you can get the strategy from our website, or you can register for ticker. For webinar. You can find it on ticker red color. Yeah, it's called in 90s called ticker. We used to watch prices on New York Stock Exchange. So right now it's not really popular, but before it was quite popular app, you can call it, that prices you could open kind of new information, and you can add this information to your computer on the screen, and every time you could see ticker price for Vodafone, for example, or other companies. They would appear on your screen, and you wouldn't have to go to other websites. So the webinar you can see on the ticker, red colored. So if you're interested, you can register. Otherwise, you can get a strategy and you could trade other pairs. In our case, we will not show you any other pairs because we trade live money. This is not demo accounts or something. If you are interested more in schools or academies, it's better for you to use other sites, other academies, because we trade other people's money and you can follow our trades. It's free. Okay, good trade, guys. I'll speak to you later.
It's been ongoing. And I think to answer your question, it's a combination of all of that. Brexit has been an ongoing conversation for at least the last 3 years, highlighting the specific needs of the fashion industry and how difficult it was predicted it would be. And some of that has come true. You then add COVID on top of that, and it's been very difficult for the industry.
So what's the one thing that the industry in the UK now needs from government? I know we have the budget tomorrow. Has government done enough to support the British fashion industry, which frankly has been, alive and kicking up until the pandemic?
Yes, so for the size of the fashion industry, which contributes 35 billion to the UK economy, and given the issues around COVID and Brexit, it's expected to drop by about 10 billion. It really is an important industry and needs to be looked at on a par with manufacturing, fishing, cars. We are in constant contact with government, with our government agencies, and there is conversation, but we are calling for more from government, and it is urgent.